In early April, stock markets globally were rattled by President Trump's reciprocal tariffs. Indian market also corrected sharply. On April 22nd, our country faced a heinous terrorist attack in Pahalgam and the India-Pak tensions shot up. A retaliatory action by our defense forces can happen anytime. But the Nifty is up by more than 4% in April. Many stocks are at record highs. What a message is the market sending? Welcome to Geojit Spotlight. An important lesson from stock market history is that sharp down moves and sharp up moves happen at the most unexpected times. This has been true last month also. The sharp correction in early April was unexpected. Similarly, the sharp up moves later were unexpected. The message is, it is difficult, almost impossible to time the market. That is why it is important to remain invested even while remaining cautious. Let us look at some positive factors and some negative factors which are likely to influence the market trend going forward. 1. An important market trend supporting emerging markets like India is the weakening dollar. The sharp upmove in dollar when Donald Trump was elected president of US triggered a momentum trade towards US assets. Capital moved to US from other developed and developing economies. This momentum trade has almost ended. It is even reversing. Dollar index has declined sharply from 111 on January 11th to around 100 now. Dollar is expected to remain weak. This has triggered capital flows towards emerging markets like India. FIIs have been sustained buyers in India during the last 11 days, imparting resilience to the market. Cumulative FII buying in the last 11 days is 37,375 crore rupees. This is important. 2. Inflation in India has come down. March CPI inflation was only 3.34%, well within the RBI's comfort zone. The RBI is on a rate cutting and liquidity easing cycle. Repo rates have been cut by 25 basis points each on 2 occasions. 2 or 3 more rate cuts are likely in this rate cutting cycle. Equally important, RBI has injected massive liquidity in the system. Interest rates are declining. Falling interest rates are positive for markets. 3. Global economy is slowing down. IMF's latest report projects global growth at only 2.8% in 2025, down from 3.3% last year. US growth is projected at 1.8%, China's at 4%, India's growth is projected at 6.2%, and this is by far the best among large economies. This makes India a safe investment destination. Growth is likely to pick up in India in response to the fiscal and monetary stimulus. 4. India is likely to be among the 5 ally nations, friendly nations, that will be striking a trade deal, a bilateral trade agreement that is, with the US. This is a huge positive for India. Now let me come to the negatives or the areas of concern. 1. The serious concern now is the India-Pak tensions. The market has discounted a retaliatory action by India, but the market has not discounted a prolonged conflict or an India-Pak war. Therefore, if the situation takes a turn for the worse, the market will be impacted. 2. Another significant concern is the modest growth in corporate earnings. The sharp rally in the Nifty from around 7,511 after the COVID crash in March 2020 to 26,277 in September 2024 was supported by earnings growth of about 20% CAGR. Earnings growth declined to mere 5% in FY25. Market strength can sustain only if the earnings are picking up. And let me tell you, there are green shoots indicating that the earnings will pick up. So what should investors do now? Briefly, 1. remain invested and give higher weightage to high quality large cap. Always remember that markets can surprise. When most investors think that the market will go down, it will move in a contrarian trend and move up. This is the experience. Second, since there are risks in the market now, do some partial profit booking and increase the cash component in portfolios. 3. Remain cautious. Watch out for the macro trends, geopolitical developments, and tensions on the border.